Welcome to the Daily Update Podcast, where I'll go over the action in the market for Friday, October 24th, and we'll see how things look for Monday, October 27th. Updating what happened in Friday's session, the major indexes, the S&P 500, Dow, NASDAQ, and NASDAQ 100, all hit new all-time highs, fueled by a favorable Consumer Price Index report. The S&P 500 opened with a gap up and maintained gains throughout the session, showcasing strong bullish momentum. The S&P 500 closed just shy of the psychologically significant level at 6,800, which acted as resistance. This was pointed out by the gamma exposure data, suggesting that this overhead resistance was significant. However, there is a note of caution. Trading volume was below average, which could signal a lack of conviction. While the price action was undeniably positive, the volume weakness is something that we should keep an eye on. Mega-cap tech stocks were the standout performers, driving the indexes higher. Optimism around a potential U.S.-China trade deal also contributed to the bullish sentiment, particularly with tech and communication. Meanwhile, we did see some profit-taking in energy. Looking at the economic data, the CPI report was a key catalyst, with the headline CPI rising 0.3% below the expected rise of 0.4%, and the all-important core CPI increasing 0.2% below the anticipated rise of 0.3%. The markets interpreted this as a positive signal, reinforcing expectations of a Fed rate cut in the upcoming week. Elsewhere, U.S. manufacturing came in at 52.2 and services at 55.2, both indicating economic expansion. Consumer sentiment did fall a little bit to 53.6, where it had been coming in at 55, suggesting some caution among consumers, possibly tied to ongoing geopolitical and domestic concerns. On a brighter note, new home sales did surge, likely led by lower interest rates. However, the 10-year Treasury yield did climb, but closed at 4%, and the U.S. dollar did strengthen slightly. Looking at the technicals, short-term momentum indicators remain positive, with indicators including the Williams %R, CCI 14 and 20 showing strength and growing positive conviction. The S&P is holding out above its 20-period moving averages, and we are seeing some improvements with the technical indicators. However, the index is getting stretched. It is getting far away from its 20, 50, and even 200-period moving averages, which could signal a potential pullback at some point. The short-term ADX indicator is currently below 20, suggesting no trend, and the lagging volume that was mentioned earlier reinforces the need for caution. While the market is riding high, these mixed signals remind us to stay vigilant. Looking at the sectors, tech and communication helped lead the charge higher, while staples and energy saw some declines. The market's focus on mega-cap tech and the potential trade deal with China continues to shape the narrative. Looking ahead to Monday, October 27th, there are several catalysts on the horizon. In the upcoming week, earnings will be reported from tech giants including Alphabet, Amazon, Apple, Meta, and Microsoft. These reports could either amplify the current bullish momentum or introduce volatility if the results disappoint. The Fed's upcoming meeting is also in focus, with the Fed making their announcement at 2 p.m. Wednesday afternoon. And the market is pretty much figuring in an interest rate reduction by 25 basis points. As far as seasonality, October 27th tends to show neutral to negative trends for the major indexes, so that's worth keeping in mind as well. Technically, the S&P 500 6,800 level remains a key resistance level to watch, with a potential gap fill from Friday's session also on the radar. There's also a Hindenburg Omen signal that remains unconfirmed, with the deadline looming by November 7th. In conclusion, the S&P 500 remains positive in the short, intermediate, and long-term time frames. However, long-term indicators are sending mixed signals, with the index stretched from its 200-day moving average, volume lagging, and geopolitical uncertainties adding to the complexity. As we head into the upcoming week, it's best to stay focused on earnings, Fed commentary, any developments concerning the government shutdown, and key technical levels. Thank you very much, and I will talk to you in the next podcast.